In your speech here at this conference, you pointed out that the US has inflation running meaningfully above target, long-run inflation expectations creeping higher, and yet a real policy rate that was below the level that the Federal Open Market Committee think is neutral, so not actually applying any restraining force on the economy. All those things together sound like someone who wants to raise interest rates.
Great to be with you. That's right. Their real policy rate right now is running at around 0.5%, which is lower than the 1% that the committee believes is the neutral rate. I think you have to look at the full picture, and it looks to me like policy is at or slightly below the committee's long-run neutral level.
But if you combine that with the other things you talk about, you had emphasized the risks of the inflationary pressures on the demand side and the supply side of the economy. It sounds like you think they should be leaning towards tightening. It sounds like you might have been one of the policymakers in the April meeting who actually thought they should have removed the statement against tightening in the statement.
So yes, I supported the interest rate decision, but I thought the easing bias was no longer consistent with the outlook and the balance of risks, which in my mind, the balance of risk has shifted a little bit towards the inflation side and less towards the employment side. Whether the economy will require a hike or a cut or a hold will depend on the scenario. There is a scenario where inflation remains high. There's no disinflation in the next quarter or two. And in that scenario, the economy will probably require a hike. There's also a scenario where the economy weakens materially in the second half of the year because real incomes are challenged and corporate margins are challenged. In that scenario, inflation could come down. In that scenario, we would be thinking of no hikes, maybe even a cut. So there are two scenarios to play with here.
But looking down the track, at least the markets are now fully pricing a rate hike by March 2027. Given where we are now, how we think things are going to proceed with oil prices and some of the risks on the supply side that you talk about, do you think that's a sensible thing for them to price?
Again, I think there are two scenarios here, and I don't comment normally on market pricing. I'm more focused on what's best for the economy and for Main Street. Markets have repriced materially in the U.S. and in other countries in the front end of the curve. I think that's markets trying to understand what our reaction function is.
So I'm going to quote here, because in your speech you talk very directly about the impact of AI on productivity and the long-run impact that could have on monetary policy and on interest rates. But you warn that policymakers cannot depend on a potential productivity boom from artificial intelligence to ease elevated inflation right now in the short term. And in fact, you seem to suggest that the build-out of all the data centers associated with AI was actually putting upward pressure on inflation. Do you think the incoming Fed chairman, Kevin Warsh, is one of those policymakers that's inclined to be hoping for that?
So I'll speak about my views. I am an AI enthusiast and productivity optimist. But at present, it's unclear that productivity, first of all, is higher than the long-term average. It's actually at or below the long-term average. And so to rely on productivity to do the inflation job seems a risky proposition, because what if the productivity doesn't materialize in the future? We could end up with higher inflation today and in the future. And what AI is doing right now, it's not really expanding the supply side of the economy yet. What it's doing is it's putting upward demand pressures, through chip prices, through the build-out. In my district, I hear of construction companies shipping workers all over the country. It is specialized, trades persons to build out the data centers. So at present, it's more of a demand story from AI than a supply story, and you see that in the aggregate demand numbers and the percentage of capex that is coming from the AI build-out is material.
But of course, a lot of this does come down to how you think, in the scenario, the next sort of year and a half, that's what you're focused on when you think about where the policy is right now and in the next few quarters. There's obviously different pressures, right? Some have emphasized, even John Williams has talked about the disinflationary forces that come from AI. If you start to see people lose their jobs, if you see jobs eliminated as AI is rolled out. You've highlighted more of the supply side, the sort of upside pressures that come from data centers and other things, those kind of pressures on resources. You seem pretty clear that those upside pressures are going to be the larger factor, at least coming from the AI revolution in the next year.
I think there are two things. In the short run, I think the demand pressures are more prominent than the supply relief. I'm prepared to change my view if and when I see AI actually contributing to aggregate productivity growth, which we don't see just yet in the data, and when it becomes evident that that's actually putting downward pressure on inflation. At present, that's not where we are. Now, in terms of the long run productivity in AI, if and when we get productivity to grow above its long run average, where it currently right now is not, the impact on real interest rates will depend on how permanent that increase in productivity growth is expected to be. If it's expected to be very permanent, that will put upward pressure on real interest rates. If it's expected to be transitory, then the supply side will win, and that will put downward pressure on interest rates.
One other thing that's happened since the beginning of the Iran crisis is a real change in bond yields. And actually, we certainly think, on Bloomberg Economics, we think that's been largely due to an increase in the term premium, slightly an increase in what we're expecting on inflation, but mainly on the term premium. So in that sense, has the bond market already done some of the Fed's work for it? I mean, is that producing a meaningful tightening, even though you have a very low short-term rate?
So my interpretation of what's happened to bond markets is that they're seeing an economy that's resilient on the real side. They see a labor market that's been resilient on the real side. They see higher realized inflation. They see higher expected inflation. When I look at the decomposition, I arrive at a different conclusion than your team, which is a fantastic team. My understanding is about 3/4 of it was an increase in the expected neutral rate, policy rate that is, and about 1/4 higher term premia. Now, if you look at forward markets...
So just on that, you don't think it hasn't meaningfully tightened financial conditions if you're looking on that kind of medium term?
So I was about to say, if you look at the forward real interest rates, markets have raised the real implied forward. So the real interest rate a year from now, the real interest rate 2 years from now, have come up meaningfully in the last month or two. But
just going back to the thing, you don't think that it's made that the incoming Kevin Warsh is not his job hasn't been made any easier by the tightening in the bond market. You would still have to be focused on that short-term rate.
I think when he comes in, he's going to take a look at the. Oh, he has come in. He's been sworn in. He's going to have his first meeting next 2 weeks, and he's going to have to look at the economy, and we're all going to have to look at the economy and exchange views on the economy and exchange views on what the best policy for the American people is at that point in time.
Well, the other thing that the incoming Fed chair has talked a lot about is changing the Fed's communication tools. He said he doesn't want to see so much or indeed any forward guidance. He wants to have fewer public speeches. He wants to get rid of the dot plot. Lots of people come in saying they want to have less forward guidance, and then they find they want to say things to the markets. Do you think that he's going to have a similar kind of learning curve?
Well, he's been in the Fed before, so his learning curve will probably be much lower than somebody who had not been there before. He's expressed some views during the last year or so. Once he's in the seat, once he consults with the full committee, and I expect him to consult with the full committee on all these matters, he will try and steer the committee in a direction or another. And I think it's always healthy to look at your communications policy, your monetary policy framework, and see how to adjust each or both to make sure we're fulfilling the dual mandate as best we can.
But you're kind of on the opposite side of this, because you wanted to actually connect the dots to whole forecasts, not reveal whose dots they were, but make a bit more sense of what the dots represented, the bigger picture. Whereas he, instead of elaborating on the dots, he wants to get rid of them altogether. I mean, that's just a straightforward disagreement, right?
Well, I would say what I think I would favor the most, is that we have a communications policy that is very effective at transmitting what our reaction function is at any point in time. Right now we have the dots. We can make the dots more effective by connecting the dots in terms of transmitting our reaction function. Now, you could also think of not having the dots, but replacing them with something else that is effective in transmitting to the markets and households and businesses what our reaction function is.
The other big thing that certainly people in the financial markets have been very focused on in Kevin Warsh's comments is about wanting to shrink the Fed's balance sheet. And actually, Governor Michael Barr said just the other day that he thought that was just the wrong goal, that it would actually raise risk for financial stability and that it wouldn't necessarily reduce the Fed's footprint in financial markets. What do you make of that?
I think that's something that needs to be studied, and we need to all review what the options are for doing that if we so desired. And I think it's very different to reduce the balance sheet from the supply side, which could be very disruptive, or reduce the balance sheet from the demand side for reserves, demand for reserves as opposed to supply for reserves. If we went in the direction of taking measures that would reduce the banking system's demand for reserves, then that would be, I think, a smoother path towards a lower balance sheet in percent of GDP or a lower growth of the balance sheet in nominal terms than simply reducing supply, which could be disruptive.
But other things equal, do you kind of share the desire on balance to have a smaller balance sheet?
I think there. I'm going to do a two-handed economist now. There are some benefits to having a large balance sheet in terms of financial stability, but it's also, I think, healthy for the central bank to have the minimum balance sheet that it needs to have to operate its monetary framework and to promote financial stability. Now, so I think we need to understand where that is.
Just a last question. When you talk about communications, and we've certainly had a lot of communications about the Fed from the White House, but also we have ordinary people who are coping with the impact of higher gasoline prices. We're definitely having a conversation about higher interest rates now that we wouldn't have expected to have 6 months ago. And I think a lot of people, whether in the White House or in the broader economy, would say, hang on, what is the Fed doing, thinking about raising interest rates in an environment where it can't affect the global energy price, that's the thing pushing up inflation, and it definitely can't affect the rollout of AI because that seems to be just an unstoppable force. So why raise interest rates?
So our mandate is price stability and maximum employment, and right now we're above target on inflation, and so the possibility or probability that we might consider an interest rate increase in the future, I think, has to be greater than zero. The economy has been robust. GDP growth has been at or around potential. The labor market is right around, in terms of unemployment, right around its natural rate, around 4.3, 4.4. And so we're missing on one side of the mandate. Inflation expectations are drifting higher to some degree, and we're not missing on the other side of the mandate. So you have to take all the factors, and we have a statutory responsibility to hit both sides of the mandate.
And finally, you did mention Kevin Warsh was sort of is in the building and has been sworn in. He talked in the past about wanting to break some heads and have a sort of revolution, be an agent of change in the Fed. Yeah. Is that the way that he's presented himself internally? I think the new chair, or Chair Warsh, I should say, will be asking some very profound and deep questions about many ways in which we operate, monetary, policy, communications, operations, and so I think that's refreshing. A new leader should always come in with a vision and asking very deep questions about how things were done in the past. I expect that to be the case.